So we just had just got our guest to come on. So here's pretty much what we're going to do is we're in Raytheon bullish and we're in Boeing bullish. We have targets. We have stops set on pretty much everything. So I'm going to bring our guest on. This is a gentleman that was requested to me by Steve Orr. He was on our show about a month ago. And I haven't had the pleasure of interacting very long with Scott Bauer. So I'm going to learn a lot more about him today along with you all. Scott, are you able to hear me, my friend?
I am. Can you hear me?
Yeah, dude, you sound great.
Beautiful.
You sound great. So, Scott, you're with Prosper Trading, is that correct?
I am the CEO of Prosper Trading Academy. That is correct.
I like it. Tell me more about it, man.
We are an educational trading company. I've been in business for a long time, and we teach people how to trade equities, so stocks and options. No forex, no futures, stocks and options. We have 4 different educational rooms, and we trade along live with our students. It's a lot of education, so it's interactive, live education during the day with myself and our other traders / instructors during the day, and we put signals out all day long. And it's a real fantastic platform for people to learn and trade at the same time.
Gotcha. I love it. Is this you?
That's me.
Yeah,
me.
We've met before.
Yeah.
We went. You were at a presentation at the Money Show, I think, last year.
Sure was.
Yeah.
That's right.
Yeah. We've run into each other before. Cool, man. Very, very cool. I appreciate being on the show.
Yeah, my pleasure.
I want to learn from you. You've been in the game a lot longer than I have, and I've been doing it 11 years. But again, when I reach out to veterans, it's like I'm always interested to learn their style and their approach and their analysis and their thoughts. So tell us a little bit about how you got started in the market. Like, what was your journey?
Yeah. So I was hired as a clerk back in 1991 down on the floor of the CBOE from a baseball buddy of mine. And that's how you got into the business back in the day.
Yep.
You know, if you were in the trading business, you just kind of knew someone, no interviews, that sort of thing. And, everything just kind of started to click from there. So I went on my badge in 1992 on the floor of the CBOE, and my mentor, the guy that hired me, he was well known as one of the top traders on the floor at the time, and he kind of taught me everything that he knew, and then I just really built it up from there. And my specialty, my forte is really trading volatility, and I got into really understanding and kind of being an expert in trading volatility because I was the first and only market maker in the world to trade Amazon.com options.
Oh,
and,
nice.
So a lot of people will say, well, how is that true? How could you have been the first and only one? Well, back in the day, and again, I know I'm a lot older than you, but back in the day, options were not multiply listed. So if an equity had their options listed at the CBOE, they were not listed in New York, they were not listed in Philadelphia or San Francisco. So when Amazon.com options were listed at the CBOE, literally nobody on the entire floor wanted to trade them because they were so volatile. So I was literally the only trader on the floor, and thus in the world, market maker, trading those options for about 3 months. And I had to learn, on the fly, really how to manage volatility, because it wasn't so much, just a delta adjustment. It was all volatility. And from that point forward, I have really found my niche in teaching people how to trade, not just direction, but volatility as well.
Interesting. Okay. That's really wild, man. So when you say trade equities, I mean, you also kind of specialize in options. That's like your preference.
That is my personal preference.
Yep.
Again, we do have, I have instructors, traders that are also just trading stocks as well, but we work together quite a bit. So, if one of my stock traders sees something out there and I can take advantage of it from an option standpoint, and vice versa also.
Yep. Got it. Love it, man.
So for instance, just now, this is real live. With my room right now, we just sold some put spreads in Teladoc.
Yeah,
which we know is just getting hammered today, and volatility is through the roof.
And it's not merger.
Right. So it's down Stock is down, almost 20%. Volatility is up over 30%. Now, to me, that's a perfect recipe for selling volatility, selling premium, but it's got to, you have to do it with some sort of semblance of, you can't just go blind at it. So Teladoc just hit right around 200, which if you look at it, it's the 50-day moving average for the last 2 years. That thing has just been as good as could be of an indicator. So what did we do? We just looked at good spreads. When the stock just got down there, short term this week, collected a lot of credit, and we'll see what happens. But I always trade spreads because I always want to define my risk. 100% want to define my risk. So, if it goes against me, okay, I know what my risk is going in.
Got it. I love that. So if we're pulling up TDOC, what were you selling the weekly this expiration?
Yeah, we sold a 205, 202 and a half put spread.
Nice.
This week for $1.50.
Got it. What a wide bid ask too. Jeez.
It really is because of the volatility.
Yeah.
So I'm selling a $2.50 wide put spread for $1.50, coming off of some major support there. And we'll see what happens.
So Scott, tell me a little bit more about bid-ask spreads on options. Like, why are they so wide, and how can traders take advantage of that?
Yeah, so when you see a situation like this, it's actually not typically good for us screen traders. We typically don't want wide bid-ask markets. We want tighter ones because unlike when I was trading on the floor, when I was a market maker and the orders were coming to me. So, brokers would come in and sell my bid and buy my offer. That's not what we do right now. We are market takers, right? So when we go in and we want to place an order, unless we want to buy the offer, sell the bid, most of the time, we're putting in bids and offers somewhat in the middle of the market. Well, it's much easier to get in and out on tighter markets. So typically I will trade in stocks that have high volume, high liquidity, and tighter bid-ask spreads. But in the case of Teladoc here, this one to me was just too overwhelming and too much of a potential, given the volatility and given the massive amount of support there, at least try and not get that spread. It was, if I could get it, which we did, it was unbelievable. But I like the tighter bids and offers because it lets us get in and out much easier.
Got it. Yeah. So how do you protect in the case of a bull put spread? Do you exit? Do you unravel? Do you roll? How does the defense look on those?
Yeah, I'm not a big fan of rolling. I teach my students that literally I only roll a position if there's a really good technical or fundamental reason to do so, not just because I want to protect a losing trade. Okay, losing trades happen. We all have to be able to accept losing trades, and my mindset is, after learning the hard way, doing this for 30 years, okay, take your losing trade and move on. So I typically don't roll, but what I would do on a credit spread like this, where I'm selling such expensive volatility, I am not going to let this hang out till the end of the week, till expiration Friday at 3 o'clock Central Time. If this thing comes back in and gets down to, let's say, 50, 60 cents, boom, I'm out. I'll pay my 50, 60 cents for what I sold this expensive put spread at, at $1.50. And I'll take my profits on that and move on to the next one.
Got it. Okay. Do you sell over earnings as well, volatility, or no?
Oh yeah, big time. Play lots of earnings, and I love doing calendar spreads, diagonal spreads around earnings when you have the opportunity for massive vol arbitrage, massive vol disparity between that front month or that front week that is so expensive from an implied vol standpoint is something that's a little cheaper on the back end. I love trading calendars around earnings.
So tell me a little bit about that. Let's use Roku as an example. So tell me a little bit about that. If you're, so I have like the January 170, 2022 call that we were in for a little bit. So that's a long-term call, obviously, a leap. If I was to sell options against that, what do you look for? Do you do the analysis risk profile and like a broker to see, or how do you check the implied volatility? What's all that look like?
Yeah, so right now with Roku trading roughly 166, I look at this as an earnings play that the market is pricing in an expected move of somewhere about $18 or so for till
Mm-hmm.
the end of this week. So,
Mm-hmm.
if I'm bullish, let's say that's, going to be a target of, let's say, 185. Okay, if I'm bullish. If I was bearish, it'd give me a target down around, the 145 area. But let's go on the bullish side. So what I'd be looking to do is and I don't trade options going out to, I don't use leaps. As a trader on the floor, I loved trading leaps. I usually keep my options, my trades, typically within a 6 to 8 week max, going out into the future. That's just the way that I like to trade things. But what I would look at here is selling like this week's 180, which is trading, quarter to quarter right now, and buying probably next week's 180 call, which is trading about 580. So that spreads a little over $1. But the way you have to look at it also is not just from the dollar standpoint, but what is the implied vol right now? But more importantly, and this is where traders get hung up, and this is where traders get confused. When they do their risk analysis, they do their profile, whether it's on Thinkorswim, whatever it is, what they fail to do 9 times out of 10 is adjust for what the volatility implied vol move is going to be.
Mm-hmm.
Right? Because we know as soon as earnings come out, there's going to be a massive vol crush.
Yeah.
So I want to measure this spread, not what it's really trading at today, because the vol is not going to be the same tomorrow. I want to see, all right, how is this going to be trading tomorrow once that vol crush happens? And so I do my analysis that way and look to see, okay, is there a big enough disparity between the vol that I'm selling versus the vol that I'm buying and where it's going to be tomorrow or, whenever after earnings is going to be.
Gotcha. So Scott, when you're looking at something in this situation, how do market makers know the expected move? Like, how are they pricing this in? Because implied volatility has always been one of those things that has mystified me. How do people determine it?
So the easiest way to look at it, and most platforms will tell you what the expected move is, but the easiest way is just to look at what that front expiration week straddle is trading. So right now in Roku, it's stock 66. If I were to look at the 165 straddle that's expiring this week, it's trading around $18, a little bit over that. That is a very good approximation of what the expected move is.
Got it. So the one
and the great thing, what traders also many don't understand is, okay, great. So the expected move is $18. Who cares? Why do I care about that? Well, based on how the Black-Scholes model works, not getting into details on math, that expected move is calculated with a 1 standard deviation probability, which is 68% of the time. So now I've got a 68% range, probability of what the market is expecting to happen, one way or the other. Expected move does not give us direction. It only tells us how big the move is supposed to be, either direction.
Yep. Got it. What do you think about, or what's your opinion on doing covered calls over earnings?
If you're already long an equity and you're in it for the long run, love it, because you're getting, extra juice. You're getting extra premium. Love it. But with covered calls, you also have to be cognizant of, okay, if the stock really runs in your favor of your stock and against your option position, you may get that stock called away from you, but you're getting paid a very hefty premium for it.
Yeah. So, I mean, is there a certain amount of premium that you're going to go for, that you're going to try to get?
It really all depends on the stock and what my own personal outlook is. Am I looking at it as a trade? Am I looking at it as an investment? If it's an investment where I want to own this stock kind of forever, then I'm going to go out a little bit further, and I've got to get a good, probably 3 to 5% of the price of that stock. If it's more of a trade short term where, I'm just looking to maybe take advantage of this, cover my call when earnings come out and move on, I'll take a little bit less than that.
Got it. Okay. So you're kind of, man, 3 to 5% is a lot. So I mean, how much time are you selling? Are you selling 2 months, 3 months?
Yeah, usually in that case, you're probably looking at 3-4 months in that case.
3 to 4. Gotcha. So let's, what's a recent example, Scott, where you've done that in the past?
Look at Goldman Sachs.
Okay.
And that's one that does not trade, with a ton of volatility typically. But going into earnings back on, about 3 weeks ago, July 15th. Okay, the October, the October 215 calls at the time, if you look at those, we're trading, $8, $9, $10, something like that.
Wow.
Okay. So you do have to balance the amount of time again versus also where are you willing to get rid of the stock if it gets called away, right? And just be acceptance of that. But that's why it's a different mindset if you're doing it for a trade versus an investment. And it's very difficult for traders to separate the mindset of being a trade versus an investment.
Yeah, true. So bring me back to this one. That's a really good point, Scott. When you're in this particular trade and you're looking at a 215 call, that would have been an in the money covered call. So why choose in the money at that point versus out of the money?
You know what? And that's a good point. Now that I look at it, it was not the 215. It was actually the 230.
Okay, that's fine. But do you ever do in the money covered calls?
I don't do in the money.
Got it.
I typically look to 30, 40 delta options.
Okay. Got it. Are there any stocks that you just don't touch? Anything that's like on your no list?
I typically don't trade options in stocks under $10.
Okay.
For whatever reason, just over time I've found not to be as successful or have as good of analytics in lower price stocks. But there's pretty much nothing else that I wouldn't touch as long as the liquidity and the volume is out there. The liquidity and the volume is out there, I'm all for it. As long as it makes sense. You've got to manage things. You've got to get certain reward to risks based on the type of trade you make. I mean, every trade you make, no matter what it is, has some sort of risk to it. So what's that level of reward for the risk that I'm taking? And every type of strategy is going to offer a different type of reward, whether it's a calendar spread, a vertical spread, a butterfly, whatever it is. And you got to measure it on that. And I'm pretty strict. I'm pretty stringent with my metrics of when I will or won't put a trade on based on reward to risk.
Got it. So when do you I guess here's a good question, Scott. When do you get into an iron condor?
I do a lot of iron condors before earnings.
Okay.
Tried to get in one yesterday and just couldn't because the markets were a little too wide in Humana. We were trying to sell one and we were probably a nickel off, and we weren't budging and we didn't get filled. I love trading iron condors before earnings as long as, and the way that I'll set them up is where my break even, so the downside put spread, the upside call spread, so that break even point is where the expected move is at. Okay, so for the instance, we go back to Roku. Okay,
so you cut out there for a second. What you said, go back to which stock?
To Roku, which we were looking at earlier.
Yep. Yes, sir.
So the stock is basically the same place as it was, 167-ish. And expected move is $18, $19. So that gives us a range right now of, let's say, 150 to 185. That's what the market is really saying based on earnings right here, right now, with the stock trading here. That's kind of the range. So yep. I would construct my iron condor with my break-even points being 150 and 185. And if I can sell enough premium, the combination of selling the put spread, selling the call spread, with those areas being my break even, that's when I'll put on an iron condor.
Got it. Okay, that's interesting.
And enough premium to me is, if I'm going to sell a $5 white iron condor, I want to get $2.50 for it. If I'm selling a $2.50 white iron condor, I want to get $1.25 for it. So I'm looking to get 1-to-1 odds on my iron condors.
Got it. Okay. How long do you sell? Do you still sell like front month, that month?
Yeah, at a max, I will go out 1 week. So in Roku, I would either look for the 7th or the 14th.
Okay.
I will not go out further than that.
And Philip asked a really good question, Scott. And again, I appreciate you answering all these, man. Do you have like a minimum open interest or anything, or do you look at volume?
Always, yeah. Open interest, I look to see if there's 500-ish contracts around the strike that I'm trading, right? So in Roku, if I'm looking at 150s right now, you can see there's 1,961 on the put side. Okay, but if I was going to trade the 149 for whatever reason, there's only 300 and change of those. Well, that would not preclude me from trading the 149 because there's plenty of open interest in the strikes around that. But yeah, about 500 contracts open interest is really what I want to look for, because that's going to tell me it's typically liquid and the markets probably are going to be a bit tighter, which is what I want.
Yeah, totally. And a lot of the big names, I mean, you're not going to have any issues with that. Amazon Roku is not going to be a problem. A lot of the big names won't have any kind of issues with open interest. But if you start picking on some random stocks every so often, it can be a problem.
No doubt about that. No doubt about that.
Yeah. What do you – so did you take advantage of any of this NKLA premium, like when it was at 80 and 70? I mean, those are some really crazy trades. When do you bet against one of these bubbles that are just doing some weird stuff with bear call spreads or something? Or do you do more like bear put spreads? How do you play stuff like that?
Yeah, I do more bear put spreads than I do bear call spreads.
Okay.
And I do them, when you think volatility is not as expensive, but in some of these stocks like a NKLA and let's say even a Kodak, when this thing ran up, premium levels get pretty expensive. So you just have to kind of pick and choose your spot. I am typically, I'd say I'm probably 70-30 buyer of premium versus seller of premium. And your listeners may not like that because most listeners, most traders like selling premium. I have always been on the side of buying premium. And yes, you're fighting theta, you're fighting decay, you're fighting time. But I found it much more easier to manage that way. But I love selling premium when the vol gets to a point where it makes sense to.
Yeah, interesting. So when you say buying premium, are you just talking about a lot of debit spreads or a lot of calendars?
Calendars, debit spreads. Yep.
Okay. Walk me through a recent debit spread that you played. What did you like about it? What did it look like?
Well, right now we have the Etsy 180. I'm sorry, not 180. We have the Etsy 145 calendar on that we put on yesterday. We bought it for 80 cents. So this week's 145 and bought next week's 145 for 80 cents. That's a debit. That's a calendar. I'm paying for it, but this was an instance because of earnings. Massive volatility disparity between this week's options and next week's options. So when I look at this and when I look at what the reward to risk is after the earnings announcement, so looking at it tomorrow and where volatility is going to be, I loved that that reward to risk. It was just phenomenal to me. Something that I have on right now, not earnings, is in Goldman Sachs. We actually have a broken wing call butterfly that we bought. It's expiring August 21st. And we bought the 205, 212 and a half, 215 broken wing call butterfly. We did that when the stock was right around 200.
So when
So
you're
it's
doing a broken wing butterfly, I'm not a specialist in butterflies by any means. So you're buying the 205 call,
yeah,
and then what else do you do from there?
selling the 212.5.
Okay.
So that's $7.50 wide. So a normal butterfly then would be selling the 220. You'd have $7.50 wide long and a $7.50 wide short. That's what a normal butterfly is. But when you adjust the strikes so that you have a delta, positive delta to the upside, or a negative delta to the downside, what I have here is a $7.50 wide long call spread and only a $2.50 wide short call spread. So it gives me that positive momentum, gives me that positive delta to the upside. It also costs me more money than a normal butterfly would. But this was a very bullish position, a debit spread, reducing my overall cost.
Yep.
And the reason I chose those strikes is because the time that we put this on, when we put this on, Goldman Sachs was trading around 200-ish. And he expected moves like 12 months.
Yeah.
So that gave me the target on the bullish side of 212.5.
And which call strike did you sell?
The 212.5.
Got it.
So we're long the 205, short the 212.5, and long the 215.
And long the 215. Got it. Long 215 call. Well, number one, congrats, because that's awesome that it's up.
Yeah, I've been eating some crow on it a little bit, but it's back. It's looking pretty good.
Yeah, well, I mean, that's the fun part, man. I love about trading is like you're never going to call the bottom, but you always want to. Like you get into a trade and you hold for 4 or 5 days, and you're thinking, man, this has to be the low, and it's not, and then it ends up working out. How do you hold through winning trades?
Yeah, good question. And so many of my students, after one day or even 3 hours will say, oh, I'm down 4 cents in this thing. And, I try and teach them patience and teach them we're not day trading. What I do is not day trading. I'm not looking tick by tick here. I'm position trading. Even though they may be short term, a week, 2 weeks, 3 weeks, whatever it is, they're position trades. So what I typically look for is on the losers, about a 50% loss. And typically I'll stop myself out. On the winners, I target at least 70%, if not more, on the winners. And, in that balance over time, and my winning percentage is about 63-37 or so. You take those averages, you take those percentages over time.
Yeah. I mean, that's a very healthy percentage. And again, it's just all about mitigating risk, man. That's always the key, especially to be.
No doubt. I try and teach my students all the time. We're not traders, we're risk managers.
Yeah, it's a really good point. I really like it. So in general, when you're taking trades like on spreads, how do you manage your risk from like a portfolio standpoint? Do you base it on a number that stays the same? Do you base it on
Great question.
rate?
Yeah, great question. And the way I go about it, and I teach people is you have to take each trade with the exact same risk. So that doesn't mean amount of contracts. That means the amount of money that you have up. So I personally use 3% allocation on every single trade I make. So
Okay.
let's say you have a $10,000 account. I'm putting $300 at risk every single trade, whether it's credit or debit. $300 a risk. $25,000 account, $750. So to me, it's not as important whether you use 3%, 2%, 5% allocation. Whatever it is you're comfortable with, it's great. So long as that allocation is constant. You can't be fluctuating that allocation, otherwise you'll never really know how your performance is.
Yeah. How long do you keep it the same? Like if you're doing that 3%, do you keep it for 5 months, 7 months? Because if you're winning and your portfolio is growing, at some point it changes. So when do you create that new structure?
That's a really, really good question. Typically quarterly, but you have to be able to adapt to that because we all know the ebb and flow of the markets. We all know the ebb and flow of an account can change, daily, weekly, not just quarterly. So typically quarterly, I'll do a reset, but obviously that's up for.
Yeah. So it's going to be a personal preference for sure at some point. I love it.
Everything's has to be personal preference and comfort of each individual trader who's going to have, you know, a different mindset, a different risk tolerance than the next person. However, that risk that you take has to stay constant.
Yeah. Love it. Well, I'm happy that your teledoc is bouncing, and I'm kind of with you on that one. So strong trends coming out on merger. You know, you have a lot of people trapped right here, but this big sell off into support, into strong trends, and a good trend. This is massive volume. I mean, if we look at this day, kind of similar.
Yeah, right.
A lot of
No doubt.
similarities.
No doubt. And, you know, it's great to be able to jump on and take advantage of a situation like this was, where you have not only that support, you know, so the technical reason for doing something, massive support on that 50-day moving average, but also the massive volatility pop that we saw, which allowed me to just get more premium there. I mean, to me, that's like the holy grail when you can combine those two things.
Yeah. Oh, yeah, totally agree. How do you scan for implied volatility moves? Is it broker or another site that you use?
I actually use Thinkorswim to do that, and so that you can run all sorts of different scans. But I just use Thinkorswim, nothing fancy.
Got it. Do you have any like scans for sale on your site or anything?
We don't. All my students get a copy. When they become a member, they will get my actual layouts that I use. So all of my indicators and all of that, but we don't sell any of that separately.
Got it. Cool, man. I'll find some final questions really quick, Scott. So what are some stocks that you're just a fan of for the next 4 or 5 months?
The banks for sure. JP Morgan, Goldman Sachs. I actually was a Goldman Sachs vice president and trader as well while I was on the floor. I traded in and ran their S&P 500 operation at the CBOE. So I know a little bit about the trading revenue side of how the big banks work. And this environment we're in right now, even though interest rates, we're in this zero interest rate environment, which we all know is not the best thing for financials. The big guys like a JP and a Goldman Sachs are absolutely killing it, crushing it, and will continue to do so in this environment. So I love the big banks like that. I also love big tech, not necessarily as putting on a trade right here, but on any sell-off. Like 2-3 weeks ago when the NASDAQ sold off a little bit, and all the hubbub, all the pundits in the market would say, oh, it's sector rotation time, excuse me, sector rotation change. And I was on TV every single day, which I'm on Fox Business, CNBC, Bloomberg every single day. And people, the interview would be, okay, are we in this sector rotation? I'm like, I don't think so. To me, it just looks like some profit taking. I think the same thing moving forward. Any sort of sell-off that we get in big tech, if we get one, is an opportunity to buy. I think those are the year. I really do. And I'll be, it's not a plug for Fox Business, but I'm going to be on Fox Business this afternoon with Liz Clayman at 2:05 Central. I have no idea what we're talking about yet because they never let me know until literally just a couple minutes beforehand.
Yeah. No, that is cool, man. I think that's awesome. That's amazing that you have that opportunity. That's something being able to share information and help people understand how stuff works is a really fun and incredibly exciting aspect of any teacher, anyone who really cares about helping people.
If I was not a trader, I would be a teacher. Yeah. I love teaching. In fact, in my personal life, I actually teach at the local high school, which now it's all remote learning, but I do a economics class. And then I also teach a class or help teach a class down at my alma mater, University of Illinois in Champaign, an upper level markets class. So I love teaching, and I get to combine trading and teaching, my two passions, every single day. So, I've got, it's like a circus for me every day.
Heck yes. I love it. Last 2 questions. VIX, do you look at it ever?
Always. We trade VIX all the time. I use it more so as a hedge against a portfolio unless we really get to a level where, all right, this thing is way overbought, oversold. I think right now is a great time to buy some upside VIX calls because not only is the VIX itself very cheap, to where it's been over the last 4 or 5 months, but the volatility in the VIX is very cheap as well. But now to me is a great time, either as a trade or as a protection against a portfolio to buy some upside big calls.
Got it. Yep, that makes a lot of sense. Makes a lot of sense. And last question, so Andres was asking this in the chat pane. Do you have a percentage that you try to hit every year? Is it like a daily target, monthly target, yearly target, or do you just kind of trade at the end of the year and figure out how it works out?
Yeah, I actually don't have a predefined percentage. I mean, I can tell you what it's been over the last few years, but I don't have a predefined percent that I'm looking for. Again, I really sit with those targets of stopping myself out on a 50% loss and targeting a 70% or more gain on my trades, and it all just kind of worked out in minutes.
Gotcha. Well, man, it's been a pleasure to chat with you. Thank you for sharing your experience and your wisdom and your knowledge with us today. And I will continue to chat with you over there in that other Slack channel.
Love it.
Just over time, man, just love learning from people like yourself, and I really respect your time. So thank you so much, Scott.
My pleasure. I really appreciate it.
Yeah, man, absolutely. So, folks,
have a good one, everybody.
Yeah, you too, man. Oh, what's your Twitter handle, Scott?
At CBOE SIB. So CBOE like Chicago Board Options Exchange, and then SIB, which was my acronym down on the floor. So at CBOE. So there you go.
Boom.
That's me.
Man. Thank you, brother. I appreciate it.
Have a good one. Thank you.
You too, man. Take care. All right, team. So I just followed your boy, Scott Bauer, professional options trader, CEO of Prosper Trading Academy. Again, I always like to learn new things. One of my big takeaways from that particular discussion, as always, I try to have something that we always learn. We can learn new things every single day, folks, especially in the trading world. But if I'm doing an iron condor, try to aim for the break even to be around the expected move. I think that's pretty cool. And yeah, I'm a fan. So he's been around for a while. I will follow Scott, and really great that he teaches the kids, teaches the adults, high school, college, spending time to pour into others, my friends. That is what it is all about. While the interview was happening, we did hit our target on Raytheon Technologies, ticker symbol RTX at 59. And Boeing, I actually still like it. The pressure is still kind of building. So here's what we can do on Boeing. I don't think we're necessarily going to hit our 171 target, but here's what we'll do is let's exit 10% here at market, and then we will increase our stop. So give me about 18 seconds just to throw that in the chat pane, let everyone else know. Exit 10% on Boeing at market and increase stop loss. All right. Give me a quick second. Edward says, great Raytheon trade. Thank you, sir. I mean, it was a small win, but I'll take it. I would have loved to have gotten filled on the other half an hour down there, but that's okay. Okay, so out of 10% of our position on Boeing, and then what we'll do is just slightly increase the stop, and we're going to put the stop loss to here, 167.08. So that way, it's going to be relatively more or less impossible to lose a full R on this trade. And obviously, as traders, as Scott was just talking about, that's our goal. We want to lose as small as possible. New stop loss on Boeing. So is everyone comfortable with what Boeing's doing? Are you guys all know what we are trading? Are you all caught up and everyone is comfy with everything that we're doing on Boeing? And again, we're fully out of Raytheon. Stop loss and 10% market out update. Okay, you guys are good? All right. Awesome. And again, if you're watching the recording and you watched the interview, thank you for being a part of Real Life Trading. Thank you for subscribing. And thank you for enriching lives with us. That is our mission. So you guys are amazing.